Plaintiff Arguments. This case is about auditor negligence. You are about to find out what could happen when auditors do not do their jobs properly and stockholders lose millions of dollars as a result. Auditors are hired by companies to determine whether the financial statements of the company are accurate. Auditors also investigate whether the company has proper internal control policies in place, which are policies within a company that are established to either prevent or detect significant inaccuracies in the financial statement. For example, restricting access to bookkeeping functions and computer systems or requiring managers to approve large transactions. In this case, ABC CPA firm, the auditors of Clovatec Inc. for the past 3 years, discovered an issue in the internal controls for tracking and reporting inventory during their audit of Clovatec Inc. for the 2007 financial statements. However, ABC CPA firm decided that the issue wasn't important and concluded that the internal controls within Clovatec Inc. were effective, otherwise known as a clean opinion on internal controls. Their clean opinion on internal controls was misleading and did not contain any disclosure of the deficiency in internal controls that the auditors discovered during their audit. In fact, this particular internal control deficiency, a lack of sufficient internal controls for tracking and reporting inventory, was the leading cause of the company's bankruptcy in 2009. Because of ABC CPA firm's failure to properly investigate the impact of the deficiency in internal controls, and their failure to communicate the potential issue in Clovatec's internal controls to the public, stockholders of Clovatec Inc. lost $100 million when the company's stock became worthless after the bankruptcy. The stockholders of Clovatec Inc. are suing the auditor, ABC CPA firm, for $100 million in damages for their actual losses and are asking for additional punitive damages to punish the ABC CPA firm for their negligent actions. Although auditors are hired and paid by the companies whose financial statements they examine, an auditor's primary duty is to the general public. Investors and creditors often rely on the auditor's opinion on the financial statements and internal controls when deciding if they can trust the financial information released by the company, which can greatly influence their investment and lending decisions. In this case, the stockholders of Clovatec Inc. relied on ABC CPA firm's reports when deciding to purchase stock in the company. Clovatec Inc. is a large public company that manufactures computer accessories and distributes them to large retailers across the U.S. The 2007 financial statements of the company disclosed sales revenues of $400 million and reported an overall profit of $200 million for the year. ABC CPA firm reported that the 2007 financial statements of Clovatec Inc. were accurate. More importantly, the auditors reported that the internal controls within the company were sufficient to assure reliance on their financial figures. Relying on this information provided by Clovatec Inc. and ABC CPA firm, stockholders purchased and retained stock in the company totaling $100 million. In February 2009, almost a year after ABC CPA firm released these reports, a news article surfaced indicating that Clovatec Inc. filed for Chapter 7 bankruptcy due to a sudden significant decrease in orders from stores selling their products. Details on an inventory fraud scheme had emerged, and it became evident that employees had been inflating sales revenues to meet projections and conceal significant declines in demand for their products for the past year. Specifically, individual sales teams were distributing excess inventory to retailers near the end of each quarter to meet short-term revenue projections. The sales teams were able to convince retailers to overstock Clovatec Inc. products by providing incentives, for example, highly favorable credit terms of 6 months or more with no interest. The sales were then recorded as income for Clovatec Inc. The scheme was uncovered when the demand for the product declined. Retailers were no longer able to sell the product in their stores and stopped ordering more stock from the sales representatives. This scheme is considered fraudulent since employees are receiving excess compensation based on intentionally manipulated sales revenue figures. The discovery that this significant overstatement of sales revenue figures had been occurring since the beginning of 2007 prompted the company to decrease their 2007 reported sales revenues by over $200 million, resulting in an overall loss of $10 million for the year. The restatement was also accompanied by management's disclosure of a serious flaw in internal controls, stating that the internal controls for tracking and reporting inventory are ineffective and resulted in unreliable monitoring of inventory counts and demands. This weakness in internal control contributed to the fact that employees were able to falsely inflate sales revenue figures without being detected. On the day the restatement was announced, Clovatec Inc. stock dropped 50% in value from $28 to $14 per share. Only 1 week later, following the bankruptcy announcement, the stock was considered worthless, with total losses for this group of shareholders estimated at $100 million. The stockholders of Clovatec Inc. are not arguing that ABC CPA firm would have necessarily discovered the actual fraud if they had performed additional procedures. It is well known that managers will go to great lengths to cover up fraudulent activity. Instead, the stockholders argue that the auditors were negligent in their evaluation of internal controls within the company and that their disclosures were misleading. The lack of appropriate internal controls in place at Clovatec Inc. permitted fraudulent activity to occur within the company on a continuing basis. This fraudulent activity resulted in financial statements that were not reliable, with sales revenue figures falsely inflated by over $200 million. This overstatement in sales revenue is a serious issue because stockholders may not have purchased stock in the company if these false sales were not included in the company's income. Work paper evidence indicates that ABC CPA firm identified the deficiency in the internal controls for tracking and reporting inventory that facilitated this fraudulent activity. Although the auditor will argue that they performed additional audit procedures to confirm that the deficiency they found was not likely to cause major issues with the financial statement figures, they chose not to disclose any information to the public on their findings and reported that internal controls were effective in the company. This overall conclusion on internal controls was misleading. We argue that the type of evidence the auditor relied upon in this case to evaluate internal controls, statistical sampling of transactions, was not sufficient evidence to reach their conclusions. This evidence only represents a small subset of all the transactions in the company. How are we to know that the auditor performed their duties with care when they examined the evidence they collected? They may have been biased against finding anything that would make more work for them or cause them to lose the client for next year's audit. Auditors are paid to provide their services to companies. How can we rely so heavily on the auditor's judgment when they are financially motivated to keep their job? Overall, the auditor's opinion on internal controls misled investors into thinking that there were no problems with the internal controls of the company, when in fact auditors were aware of deficiencies. The auditor did not publicly disclose any concerns with the company's controls. Instead, they reported a clean opinion on internal controls, expressing that controls within the company were effective. At the very least, the auditors could have voluntarily disclosed the deficiencies they found to provide some type of warning to investors about the problems within the company. We claim that because of their negligence and resulting misleading statement within their audit opinion on internal controls, the auditor did not signal investors of the true potential that the financial statements may not be accurate. Therefore, I am asking on behalf of the stockholders of Clovatec Inc. that you find ABC CPA firm liable for negligent misrepresentation. We ask that you compensate the stockholders $100 million for the loss in stock value and that you punish the auditors appropriately by awarding punitive damages as well.